Yes. Oh, we should see my FPs.
With film.
Oh, okay.
Yeah.
It's Bernanke and central bankers to the rescue.
The Federal Reserve stands ready to do whatever is necessary to protect our financial system.
Stocks push their biggest two-day gain of the year, and it couldn't have come at a better time with the market turning lower for 2012 earlier this week. And so this special show couldn't have come at a better time either. From the financial center of the Midwest and the trading capital of the world, a special trading town hall, markets in turmoil. In 16 hours to the next market open, we got a full table of traders.
It's dark, and we're wearing sunglasses.
Time for Fast Money, Chicago.
After Chairman Bernanke dodges the question on QE3, so the question is, how are you trading it? Pete Najarian, give us the first answer.
Well, I think when you look at the volatility index, the way it's been slammed over the last couple of sessions, we're down over 20% from the highs on Monday. I mean, that's a pretty significant move to the downside. And then when you look at what really did perform and held on today, it was the industrial space. Look at names like United Technologies and Boeing and 3M and all the rest of those kind of leading the way and at least holding on to some of those gains. I think it was an impressive rally early. I think the financials weakening late, that was concerning for sure. So I think going into tomorrow, obviously you've got to be a bit cautious, but the kind of move that we've had and the fact that we're maintaining where we are right now, I think is pretty gives you some confidence.
This morning in terms of the rally, do you see it as the greatest gift possibly to traders out there because it was time to take profits when we were in a tight trading range and we're at the top of that range?
I have mixed feelings on that because I think people are looking at somewhere below the market and one more test at 1290 in the S&P, using that as a proxy, but whatever market you're following is actually a place to hold and then buy. What was disappointing is China's rate cut, to me, should have been an opportunity for people to start taking some of at least your reflation trade a little farther. The dollar actually, to me, has held up well, and despite the sell-off over the last couple of days, the DXY is holding a range that actually still tells me it's in an upward trend. So China's rate cut at 7 a.m. at least New York time when I was on a plane and watched. I said, "Oh man, I have a lot of shorts I might need to cover." Not really, and in fact, that was the high of the market. And I don't know that we actually hold on to a lot of this. I think there was a lot of pessimism out there. I'm not sure what changed in the last 24 hours, other than China, which I think is important news to talk about.
Hi. How are you?
Hi.
Good to be here.
Have you had
Look
a
at this.
wiener
This
in
is
Chicago?
excuse me?
You had a wiener
Pardon me?
as well? Chicago's known for their hot dogs.
Not yet. You can see I'm losing weight, so I try not to get into the footers. Yeah. Look, I mean, it's not everything we've talked about. Yesterday we talked about if it got above 1290, we were going to test this 1320, 25 level, and we got exactly there. 1320 failed. I'm in sort of the pessimistic camp here. If you had told me before the day started yesterday that China was going to cut rates, I would have said the S&P should have gone to at least 1350 and held, and it didn't. So the fact that we're back down here did not get the help of the financials pretty much all day leads me to believe we're going to test 1290. 1290 holds. I think we're off to the races on the upside, but if it fails this time, my sense it'll get that 1205 level that I've talked about.
How are you feeling about the markets, Karen? We have one important event over, that being, of course, Ben Bernanke, but we also have the Greek elections coming up. We have G20 coming up, a host of other events in the pipeline.
I was actually somewhat disappointed today. I thought what this market really needs is clarity, and what we keep getting is no clarity. We keep getting, yesterday with the EU, we didn't really get any clarity. With Bernanke, same thing, no clarity. And so it's hard to really feel great about putting money out there. But to me, I think what we have to do is just pick prices, put a bid out there, and I know I'm never going to pick the bottom, and just live with it. If it's a price that I want to own it, I will.
Dr. J, what was your observations of the market today, especially when it comes to positioning ahead of these events?
I think, number one, Bernanke kept his powder dry. We refer to that a lot, of course, when he could make some sort of a statement, and he's very aware that if he does, it's going to move markets, and he'd rather hold that for when it's needed. So he didn't have to today because of China, and because, quite frankly, gasoline prices adjusting as they have and so forth. Both those are positive. Also, I think you've got the potential for the nervousness ahead of course, the election that's just over a week away in Greece. A lot of traders are focused on that, as well they should be. If you're a short-term trader,
taken money off the table, as Tim talked about. If you were on the long side on the 100-point pop in the Dow today, brilliant trade. On the other side, if you're a longer-term trader and you're not in and out every day like that, I think the setup is very strong. China rarely makes just one rate cut. They're going to make multiple rate cuts.
No, it's the first one in 4 years. In fact, the last one came in the last crisis. I mean, even though we're interconnected in this entire trend, I mean, that was back in 2008.
Yep. And if they make multiple cuts, you don't want to be on the short side of that.
Right.
To Guy's point, we trade down to if we trade down to 1290 and we get that bounce again, I'm pretty bullish about that. And like I say, the Fed chairman has dry powder, even though there's not a lot you can do with twisting and quantitative easing. Still, that's dry powder.
So let me key off what Dr. J said, and let's talk some specific stocks here. If we are to believe that this is the first in several rate cuts coming out of China, and we don't want to be on the wrong side of the trade, should we get into the likes of the Freeport McMoran or some of the industrials out there like a CAT?
Well, there's a lot of people that think because China moved, things might be a lot worse than we think. They have a slew of data that are coming out later this weekend and into next week, and at least the GDP number, people are, in the next couple of days, we might even market downgrades of China GDP, which was something that threw us into a tizzy in the first quarter. So if you think it's a multiple cut, though, I think it's always, you go back to fantastic companies that are trading at good valuations, and in the commodity space, that's a really tough call, because Vale, if anyone's going to benefit from China at reheating the oven, it's Vale. And these guys at 4.5 times EV/EBITDA, I think are a very interesting place to buy it, especially with Brazil's currency having been devalued massively. So material stocks, sure, that's the place you run, but I don't think you uniformly buy them. And as I've said a couple times in the last couple of weeks, because I've been talking about Freeport for a couple of months, and there's more than a few people out there who've been tearing me a new
But
one.
forget Freeport. It's the only name everybody brings up when you talk about copper. How about Southern Copper? Gives you a 7% yield. All it does is essentially trade between $29 and $35 a share. Here it is trading $29 a share. You get that yield. And over the last 3 months, 6 months, 1 year, take a look at the chart, outperforming Freeport every way across it.
Yeah, but again, on some level, picking stocks on fundamentals here, I'm not even sure is the call. On a relative outperformance, you're absolutely right, but you better hope that this is happening, because Southern Copper traded all the way down to $4, back in 2008.
Of course, with the Fed meeting on tap, the question is, what is the Fed likely to do next? Let's delve deeper into what we heard from Ben Bernanke today with CNBC's Rick Santelli. He made it all the way out to Harpo Studios from the CME this morning. Rick, good to see you.
And I was on another show 15 minutes ago.
The closing bell.
We were on the air this morning.
We were, yes.
What R word did I use? Rorschach.
Rorschach,
What did Ben Bernanke say? I'll draw you a picture, an ink spot. Ask 20 people, you get 20 different versions. It's the same with Fed policy. You listen to Janet Yellen last night, to listen to grown men say, well, see, she's painting it this way. Ben can't paint it that way, but on the 19th and 20th for the 2-day meeting, it's still a possibility that they resurrect the twist. And I wouldn't doubt that. I think in the end, I'm a pragmatist. I think it's a diversion to talk about the Fed. Not that they don't have power, not that they can't move markets, but they certainly have been ineffectual in using some policy decisions to do things like lower the employment rate. And if people want to run at me and say, hey, we were over 9 and now we're barely over 8, I'll say the labor force participation rate, you move it up to the same level as that 2 years ago, we're back over 9%.
Rick, let me ask you, do you think that the China move was part of any kind of coordinated effort? Was Bernanke aware of it? Did that influence what he would say today?
See, I have no way to answer that question, but I will tell you this. I was talking to John off camera. There's been a couple of stories, one on the Wall Street Journal website, about stockpiles of iron ore in China in the port cities. So you see a lot of this. We know that there's overbuilding. We can see commodity prices. We know that they've leveraged their copper as collateral for loans. I think it makes sense there's a slowing. Is it coordinated? I can't tell you, but even if it is, so what? I don't know that it's going to change the equation. I think what ails the world, what ails Europe, what ails the U.S., there's a lot of things we can do, but most of them aren't going to be possible till after the election.
Rick Santelli, always good to see you. Thanks for having us in your lovely city.
Thank you. It is a great city.
It is.
Chicago!
But isn't it a great thing for investor confidence to see the Fed, the ECB, and the PBOC say essentially that we will step in if things get bad, and shouldn't that be a lift for investor confidence at least?
See, Tim made a point that how bad must things be in order to have this, consolidated
Maybe the central bank backstop.
effort? Well, I'm not certain that you do anymore. My sense is if the Fed acts again, that maybe you get a one-day knee-jerk reaction to the upside, but I think it'll be short-lived, and I think this time the markets could actually crater. Again, how bad must the world be right now? How much bad must the U.S. be in order for us to go down these roads? And I think Rick talks about that all the time. So I am not nearly as optimistic as I would want to be. And I fear that the markets, again, if we technically break down through this 1290 level, it could get ugly very quickly.
And again, you know, the ECB, Mr. Draghi made a point to really tell policymakers that I'm not going to do your heavy lifting for you. And I think this is what I hope Big Ben's doing over here, but that's something to think. You know, central banks around the world know monetary policy can only do too much, and we're really at a place where fiscal policy has to take over.
All right, next right here, the Fed may be in wait-and-see mode for the time being, but Treasury yields continue to plumb the depths of just how low will rates go. Joining us now is a Fighting Irish alum, Jeff Kilberg of Kilberg Capital. Jeff, good to see you in person here in Chicago.
Hey, Melissa, welcome to Chicago.
What are your expectations in terms of the low end of the 10-year yield?
Well, I think Karen hit the nail on the head. We're going to see an emotional trade in June, and as we see these rates, much emotions in the markets, technical trade. We talked about this 1.67 for a long time. We're following the German boom. The German boom went down to 1.19 in that panic on Friday. It could go down there in the event we don't get the clarity we're looking for. But right now, if we get a coordinated central bank effort, we are going to see it go back in this range of 180 to 210 as the C's come. But right now, emotions are high.
And when it comes to the German Bund, is there a spread that you expect the 10-year yield versus the Bund to maintain? Is that how we should look at it?
When you pull up a chart and you look at it, it's just been tailing it. But when it got inverted there back in March when everyone thought everything was well, you saw it tail. So it's about a 20-tick kind of situation that it could catch up with.
All right, Jeff, great to see you. Thanks for coming by. Jeff Kilberg, Fighting Irish alum. All right, so obviously rates are going to go higher. Does that necessarily mean that it's good for the financials? Let's trade this thing, right? We showed you a chart yesterday, the correlation between the XLF, the ETF that trades the financials, and the 10-year yield, 68% correlation on that with yields. So if yields are to go higher.
Well, it depends on why they go higher. If they go higher because the economy is improving, then I think that's good for banks. If, I hope that's why they go higher and not some spike, whether it's the oil or some exogenous spike that just causes inflation into the stagflation. I am long banks, hasn't been the right place to be, but I still own the JP Morgan Bank America.
Right, the answer to your question is I'm not certain that would be the case. And my concern, and Killer can speak to this, as can Rick, I mean, rates have gone down at a very methodical rate, but I don't think they're going to go up in the same way. I think it's going to be extraordinarily fast, which could be incredibly detrimental to the equities market. So rates higher, I don't think it necessarily means stocks or banks go higher as well.
You know who's been right on the financial trade for a very long time?
Pete Jarian.
Pete Jarian, exactly. Read my mind. So Pete, what are you doing now in financial?
Well, yesterday, as a matter of fact, Credit Suisse is one of the names that hit on our heat seeker. A lot of unusual activity in there, a lot of upside buying. And I would also keep an eye after this big sell-off in JP Morgan today, the July 38 calls, extremely active again. I'm not saying the bottom's in for the financials, but as Mohamed El-Arian was talking about earlier with Maria Bartiromo, he talked about this is a trader's market, not an investing market. If you want to trade the financials, I think there's some great opportunities.
Got to hedge a break here. Coming up next, our special town hall summit. Markets in turmoil continues. Our team of traders and strategies to find returns amid all the volatility in the markets right now. Plus, a power-packed lineup of guests still to come. Jim Metcalf, USG CEO, Tom Ricketts, In-Capital Chairman and Chairman of the Chicago Cubs, and Rahm Emanuel, Mayor of Chicago, all coming up. Much more fact live from the Windy City up right after this.